Welcome, everybody. I'm Joe Hillstead. I'm a tax partner here at Squire. This is the first in our two-part series on the One Big Beautiful Bill that was signed into law on the 4th of July. So we'll be covering the business and international tax provisions of the One Big Beautiful Bill. And stay tuned or come back next week, same time, Tuesday the 29th at 10 a.m., where we'll be covering the individual income tax provisions of the One Big Beautiful Bill. So we're very glad to have you. We want to make this as interactive as possible. If you have questions, just let us know, or if we need to clarify, just let us know. Brandon's covering the online portion. I think we've got approximately 50 or so folks online. So let's get started. So let me give you a little bit of context and history regarding this bill. So the House of Representatives passed the One Big Beautiful Bill Act in May. It was then sent to the Senate. The Senate had some changes to that. It was still an apples to apples bill that went to the Senate. The Senate then passed their version of the bill on July 1st. It was razor thin vote margin. I think it was in the Senate, it was 51 to 50 with Vice President J.D. Vance casting the tying vote in the Senate. In the May version, the House was like 215 to 214 originally. So the Senate version then needs to go back to the House. And you probably remember kind of the drama that existed during that time frame in that first week in July. There was record-setting debate and voting and all these things. Ultimately, the House passed the Senate version on July 3rd. It went to the president's desk. It was signed on the 4th of July. That's the context. So, I think we want to give you a little bit of the executive summary, right? You probably need to go back to your C-suite and report on, hey, how does this really impact our business? And so here are the bullet points. Number one is that Congress broadly succeeded in giving us some certainty with respect to tax. Many of the Tax Cuts and Jobs Act provisions that was acted back in 2017, many of the favorable things like reduced rates, the qualified business income reduction, higher standard deduction, all of those were set to expire in 2025. And same thing with the business provisions that were set to expire. So businesses were left feeling uncertain as to how they should make investments. What are the tax implications going to be? Because we don't know what's going to happen with all these TCJA, Tax Cuts and Jobs Act, what we call orphans. Orphans is that they don't have a permanent home in the Internal Revenue Code. And so Congress did give us some certainty, especially in this season of uncertainty where we've had tariffs since Liberation Day, and there's news in that happening just about every day. So these provisions are favorable. For the most part, they're favorable. They are incentivizing businesses to make capital investments, to invest in manufacturing, to buy U.S.-made vehicles. It's consistent with the administration's policy of this America First, right? So these are pro-business, pro-America First policies. So I've got this bullet point here where we achieve some permanency in quotes, right? We made permanent many of the provisions in the Tax Cuts and Jobs Act, but this bill was done through the reconciliation process, which means that Congress can pass this bill with a simple majority. They don't have to go through the 60 vote requirement that the Senate, they can bypass the filibuster process, right? And we've seen these reconciliation bills with the Tax Cuts and Jobs Act in 2017. We've seen it in the Inflation Reduction Act in 2022, when the Biden administration introduced the clean energy provisions and incentives, and now we've done it through another reconciliation bill. So I put quotes in permanency here because if we have an administration change, or if the Democrats take Congress, they could change tax law, easily, just like they've done here. So I think the last bullet point for the C-suite is the bad news is for companies that invested in the green energy, the clean energy incentives under the Inflation Reduction Acts. Those are going to all be phased out, ultimately terminated. Right? Those were the provisions that were used to pay for some of the provisions that our team is going to talk about today. So that's the context. My presenters today are Chelsea Smith and Doug Flake. They're going to talk about the business provisions, and then I'll follow up with the international provisions.
Thanks, Joe. Trickiest part is figuring out how to handle this. Forward. Okay, business tax provisions. Okay, so talking a little bit about the history of the business interest deduction. This kicked in, started in 2018. Interest expense has always been one of those things that's, or business interest, you have to go through the process of determining business versus personal interest, but we're talking about business. We're assuming it's all business interest. Prior to 2018, it was always fully deductible. In 2018, they phased in, there was a 4-year phase in, I believe, where it was, and I could be off on some of my history here, but it was a 4-year phase in where it was, the limitation was 50% of earnings before interest and taxes. So you were, I'm sorry, 30% of EBITDA, earnings before interest, taxes, depreciation, and amortization. So basically all those things were added back, and you were able to take the higher limit, which allowed more of the interest. So through 2021, we had that. 2022 and 2024, we've been dealing with the 30% of earnings before the EBIT, earnings before interest and taxes. So that means you go ahead and deduct the depreciation and amortization and have a lower limit now to calculate the 30% interest limitation. So for businesses that have a high debt ratio, that was going to be a business limitation. So any interest that's disallowed has to be carried forward, and it can be used against excess business interest, so income above that limit in future years from that same company. So it's a pretty big limit there. The change that we made here for 2025 and going forward is that it's now 30% of EBITDA. So say a business has $2 million of income, $1 million of depreciation, it's now going to be the, well, I mean, if it's $2 million of, say there's $1 million of net income, $1 million of depreciation, our EBITDA, our calculation interest limit would be that $1 million of income with the depreciation added back. So it's now $2 million times the 30%. It's a lot more favorable. That's going to allow more interest. Less will be limited and less will have to be carried forward there. Now, one thing that came into play that was put into the law that is going to be a disadvantage for any business that is required to capitalize interest as part of its production process is that the allowed interest first has to be applied to capitalized interest. And then any interest that is not required to be capitalized can be allowed to take it as a deduction. Now, one big caveat on this, if for a business with gross revenues of less than 31 million, and that's an average calculation looking back for the last 3 years, any business with less than $31 million is exempt from this requirement. There's no limitation at all. So it's really higher, relatively higher income businesses that have to put this into play there. And as far as questions, if anybody has questions, let us know. We will save some time for the end, but I kind of like having questions as we go through the process.
Yeah, just a comment, right? This 163J provision, this 30% of EBIT or EBITDA, as the case may be, really impacted private equity due to the leverage nature of their acquisition.
Right.
And so now it gets slightly better now with the EBITDA limitation compared to the EBIT.
Yeah. Yeah, I mean, this is a new thing. We've been dealing with it now for 7 years or so, but it's a new thing here. Okay, switching to the qualified business income deduction. This is something we've had in place since 2018. This is for pass-through businesses that pass their business through to individuals. So it's going to be, it actually can be a sole proprietorship, it can be a partnership or LLC that issues K1s, it can be an S corporation which issues K1s. It doesn't apply to C corporations because C corporations have their own different tax rates. But this is a pretty powerful provision as well. So the House version actually was going to increase this to 23%. The Senate version, which was finally enacted, kept it at 20% of qualified business income. Which is the same place where it's been since 2018. The service income, so services like legal, accounting, healthcare, not engineering, not architecture, but it does include some types of consulting businesses, is going to be limited generally for the phase out start at 495,000. The new act gave it a higher phase out threshold. So my understanding is it now goes up to 545,000, which is 50,000 higher than it would have been under the old law. So a service income, which used to be allowed for people below those income phase outs, disallowed for people above them, it has that, and once you're above that, then you just lose it completely. Now, if it's non-service income, so really manufacturing or general business or most things there, you have to have wages allocated to that. So basically, the business has to have payroll that gets allocated to the owner for purposes of calculating this, or property basis limits. The limit, it would be the 20% of qualified business income limited to 50% of wage allocated income for that owner, or 2.5% of property basis for that owner. And there's some variations on that, but I won't get into that there. But this is pretty powerful. This really effectively, a person in the 37% federal tax rate can bring their income down to 29.6%. So this is a pretty powerful thing. We've been using it quite a lot. So there's a new small provision put into the law. There's a minimum $400 deduction for those with at least $1,000 of material participation qualified business income. So not a big deal there, but it's something they put in. It'll be a small benefit for anybody with that. Qualified small business stock. This has become a lot more powerful as well. So the history here, it's starting in 1993, there was a specific date. They allowed a 50% exclusion on stock that qualifies as small business stock there. And then in, I believe, 97, they changed it for a bit of time to 75% exclusion. In 2010, at a certain date in 2010, it became 100% exclusion. So what is qualified small business stock? I'll talk about that a little bit. It has to be C Corp stock. It cannot be pass through, cannot be LLC or anything like that. It has to have been acquired after 1993. And again, we have these benefits for which I'll talk about in a minute for stock acquired after 2025. It's got to be C corporation. It's got to be originally issued to the person. So a lot of times C Corp founder stock will qualify there. You can actually have stock options that are granted to employees that many times will qualify as well there, but it depends on the size of the business. The qualification must be that at the time the stock is issued, before and after the stock is issued, the gross assets of the company had to be under a certain threshold. That old threshold was $50 million. The new threshold effective for stock acquired after July 4th, 2025 is now 75 million. So that kind of bumped it up. So more stock is going to qualify there. I mean, that's a pretty big limit there. It's not a huge business, but it's a pretty generous business for that. It has to be an active trader business, meaning that 80% of the assets of the corporation are used in operating a qualified trader business. A few types of business are excluded. Personal services generally are excluded. Financial, some farming, and resource extraction businesses are excluded. And it must be held by a non-corporation. So that includes individuals, it includes LLCs. LLCs can be owners of the C corporation and take this benefit. Even S corporations can be owners of this. So a S corporation for this purpose is not considered to be a corporation. Now a C corporation can't take this benefit otherwise there. But the big benefit that came in for 2025, so the old rule is you had to hold the stock for at least 5 years. Now there are rollover provisions where even historically, the holding period is less for that. But in order to take the exclusion on sale, the old rule was it had to be held for at least 5 years. Now there's benefits there. So for new stock acquired after 7/24/25, if you hold it 3 years, you can get a 50% exclusion. If you hold it 4 years at 75%, if you hold it 5 years, you still have that 100% exclusion. Now this I think is going to come into play and be a factor in what type of entity you want to have. So those that are in C corporations, this is kind of a reason to stay there, not really consider going to an S corporation. But it also depends on, it goes, you still have to look at how are you going to operate the company. If you're going to be pulling cash out of the company, generating cash and pulling that cash out as salary and dividends for the next several years, then maybe a C corporation is not a good way to go. But if you're looking to reinvest earnings in the company and potentially sell the stock maybe 5 to 10, 15 years down the road, this can be a very powerful provision. Opportunity zone. So this was a provision put into place starting in 2018. A lot of people have put into. So basically, the benefit of opportunity zones is kind of like a 1031 exchange, except in some ways it's better than 1031 exchange. In some ways it's more limited. 1031 exchange has to do with real estate. If you sell one piece of real estate, go through the proper procedures and put it into new real estate, you can avoid paying any tax on the gain in that real estate. An opportunity zone is a little bit more favorable in that if you sell any type of asset that generates capital gain for you, you can take the gains on that property and put it into a qualified opportunity zone and avoid and defer all your tax together on that. So it's really a deferral. For the most part, it's not an avoidance, but there are some provisions in there that potentially do allow for avoidance on that. I mean, eventual avoidance, not a negative avoidance, but a legal tax reduction and avoidance there. An opportunity zone is designated under provisions by the state. And one of the things, so the last bullet point I have mentioned is that the state now has a process that they go through in designating an opportunity zone. It is always a distressed area. So since this has been around, starting in 2018, it has to be an area that's designated by the state to be a distressed area. There are a lot of rural provisions. I believe they've even limited those there. That's a complex process that I won't get into, but it's got to be an investment in a business in one of those areas. There are a lot of qualified opportunity zone funds. So if you're looking for a place to defer tax and you do the right amount of due diligence, which is critical, you can find a place to put your funds and avoid capital gains. Now, one of the benefits an opportunity has over a 10 zone deferral has over 1031 exchange is that all you have to do is defer your gain. With the 1031 exchange, you have to defer all of your proceeds to avoid tax on any gain. Qualified opportunity zone, if I sell something for $1 million and I have a 500,000 gain, all I have to invest is 500,000. I've avoided all of that gain. There are benefits to holding that as well. So if you have a 5-year holding period, you get a basis bump up to 10% of the gain originally deferred. So if I had a $500,000 gain and deferred that after 5 years of holding that, I would increase my basis by 10% of that, or $50,000 that I won't pay tax on in the future. After 7 years, there's an additional 5%. So added to the 10 is 15%. And then after 10 years, there's a basis equivalent to a fair market value of the sale. So it can be a pretty powerful thing. The cautions with an opportunity zone is that you are, by definition, investing in a distressed area. So you want to be cautious on that. You want to do a lot of due diligence with it. Make sure the investment price you're paying is appropriate for the type of investment you have.
Doug, here in Utah County, the opportunity zones are South Provo, American Fork, and Salt Lake County, West Valley. God,
and there's some of the kind of, if I remember right, this is going back a while. It seems like there was some of the just west of the downtown area that was in Salt Lake. That was,
And Gateway is still, I think, considered an opportunity zone, as well as the old Big B building, and a little further south from there, like you're headed toward Industry.
So, but keep in mind, these rules, I believe, will change, so stay updated. So these new provisions, so it's a rolling 10-year designation. It starts in 2027, so we're still a ways out on that. But it's something that can be pretty powerful there. Okay. Chelsea.
Okay.
Thank you.
All right. Hi, I'm Chelsea Smith. I'm a senior tax manager here at Squire, and I lead our tax incentives and credits. So I want to talk with you guys about the changes to bonus depreciation in section 179. And then after that, we'll talk about some changes to section 174, which is research and development expenses. So, which in my opinion are the most exciting parts of this bill change. But, you know, exciting is relative. So, bonus depreciation, what we had seen is that the provision was saying, hey, over time, we are reducing this 100% incrementally by about 20% every year. And so in 2024, we had seen that go down to 60%. We expected in 25 that it would be at 40. And this has now changed that 100% deduction for qualified property placed in service after January 19th, 2025, and it makes it permanent. So we no longer have to worry about some of those purchase considerations. If bonus is what you want to take advantage of, we don't need to say, okay, well, do we need to push this in before the end of the year in order to take advantage of the higher bonus rate? It's just 100%. And then this 100% deduction for qualified production property, this is actually a new piece of the provision it added in this qualified production property. And you can see there that the definition of qualified production property, but essentially just says, hey, it's things that are integral to how you're doing business. So, and then section 179 expensing, this isn't as relevant these days because of the bonus. And we started to see more conversation about 179 coming into play as we saw bonus drawing down. But one of the ways that 179 is more frequently utilized is if you are electing out of bonus. Electing out of bonus means that you have to elect out for all similar classes of assets. So if you're purchasing a swath of assets that's 5-year or 7-year, depending on how or what type of asset that is, section 179 might be a secondary option for selected assets where it doesn't have that provision that you have to elect out at the class level. So, and that's just a cash flow planning mechanism that we can sometimes utilize, but there are a lot of ways with the IRS that if we're electing out of bonus, sometimes it keeps us solidified in that choice year over year. And so it's something we certainly want to talk about before that election is made. Any questions on bonus changes?
Just to comment that the bonus, I mean, so 179 has always been very powerful for a small business, but for a large business that's going to be putting in service more than 4 million a year, it's kind of off the table anyway. And so you do have to go up to bonus depreciation.
For sure. Thanks, Doug. And just as an FYI, the biggest change to this is 179 used to have a lower cap. So essentially you couldn't utilize it after 2.2 million, 1.9, something to that effect, and it's just raised that cap.
Can I ask a question?
Yeah.
The bonus depreciation goes January 19th, 2025. Does it start to tear down 20% annually?
No, It's
till
100% and it's permanent.
Wow.
So that will not change. We don't expect that will change. Again, going back to what Joe kind of, the preamble to all of this is to say, hey, this was done under a budget reconciliation. And so if we get into a new administration or a new Congress, we could have another budget reconciliation. But for right now, this is permanent. I'm sorry about the size of all the words on here, but I figured, we'll just talk through it. So research and development expenses. I know I've spoken with a handful of you either online or in person about R&D and specifically R&D expenses or R&D credits. So section 174 governs what defines R&D expenses in general. So but the old rule, what we were following, starting in 2022, was that you had to capitalize your R&D costs and amortize those over 5 years. So, and foreign, it was 15. So, this really tied the hands of a lot of our entities with high R&D spend because that capitalization was putting people into potentially showing income or just not as big of a loss, what we might want to show either flowing through or at the entity level. So the new rule is split by large businesses and small businesses. Doug defined large businesses earlier, but that's 31 million and it's averaged over 3 years. That's also an indexed for inflation number, with the base being at 25 million. So the new rule for large businesses is that starting in 2025, for tax years 2025, we allow an immediate deduction of R&D expenses. You can still use the old rule. You can elect to capitalize and amortize. So there's some cash flow or just planning that can be done here. And for large businesses, we have a catch-up provision. So it essentially says, hey, 22, 23, 24, the IRS required that we capitalize and amortize these over 5 years. If you would have preferred to expense these immediately, you can elect to do that either all in 2025 or over 2 years in 25 and 26. And the mechanism that we expect to be used in order to claim that is a Form 3115 and a 481 election, which is just an additional form in your tax filing. And then, unfortunately for large businesses, there's no retroactive amendment. We can't go back and say amend 22, 23, 24, and then flow those through. It is only the catch-up method that is available to us. Now, small businesses, really, it looks very similar. So for businesses under 31 million, we have that same immediate deduction. So starting in 2025, we can immediately expense R&D costs. There is still the optional capitalize and amortize, so stick with this old rule. But we add in the amended return option. So if you capitalized R&D costs in 22, 23, 24, we can amend those returns in order to immediately expense them. The caveat is that you need to make that choice within 1 year of July 4th, 2025. So we have a 1-year clock that has started in order to take advantage of this amended return option for capitalized costs. Small businesses have this same catch-up method available to them as well. So let's say the 1-year clock is busted and you want to do the catch-up option, you can do that and claim either all of those 22 to 24 expenses in 25 or over 25 and 26 under the same 3115 mechanism. So I added this small piece at the bottom here because many of our clients who are participating in research and development expenses also want to consider and should consider the R&D credit. So that is governed by Section 41, and this bill did nothing to change the mechanisms of how you claim an R&D credit. So Section 174 is kind of all of your R&D expenses. Section 41 implements that 4-part test that says, hey, you know, we want to have uncertainty, we want to have a hard science, we want to have the essentially process of experimentation with your costs in order to qualify them under Section 41. And then based on how many of those qualified research expenses there are, we'll go through a calculation of what that dollar for dollar credit is under Section 41. Again, those mechanics are unchanged. One of the things that does come into play is what's called a 280C election, which just says, hey, if you do end up getting a credit, we either need to reduce your 174 expenses by the amount of credit or just take the net amount reduced by the highest tax rate. So that's the major changes to research and development or 174 capitalization, but we're really excited about this. What we'd like to do with anybody who has capitalized from 22 forward or any of those years is a cash flow planning exercise. Is it right to amend returns? Is it right to take those expenses in just 1 year or over 2 years? Just depending on, you know, what kind of entity structure you have, what 25 looks like as far as income levels, what 25 and 26 look like. And we have that plotted out. We have a chart ready to just put on top of your results for those either previous results or future plans. So do you want to finish the other provisions?
I'll go through these now.
Can I interrupt you there from the question online,
Sure.
about the qualified small business stock? And were there any changes to service businesses being eligible to claim qualified small business stock?
My understanding is no, it's the same old definition. So if it's service business, service business, the ones that don't qualify are service businesses, financial, resources extraction, and some farming. So there, so yeah, it's the same definition there, I believe. It just becomes more beneficial there otherwise. So just a few other odds and end business provisions. I won't go too in depth into each of these, but just wanted to kind of mention those. So these, and some of these, you know, even though we're doing business this week, we're doing personal next week. Some of these carry over there. So the excess business loss limitation, this is where losses pass through from either K1s or from are claimed on a sole proprietorship on an individual return. They are combined, anything in excess of a threshold amount, which is currently 626,000 for a joint return. It actually started at 500,000 back in 2018. It's been adjusted annually for cost of living. It'll continue to be, but this was one of the provisions that was set to expire, but it is now made permanent. And so any losses that are over 20 or 626,000 for 2025 are going to be limited at the individual level. The excess amount is actually added to your net operating loss carryovers. So you can only deduct that 626 against your wage income. There's also plenty of other limits on, you have your, on K1 income, you have to look at your passive loss limits, your at-risk limitations, your basis limitations. But if you get through those, then you'd have that. And then this would be added as a net operating loss, which again, can be carried forward against future income. Net operating losses can no longer be carried back. That was a 2018 rule. They can be carried forward and they can offset up to 80% of your income in later years. So for employer provided childcare, there used to be a $150,000 max credit for that. There is now a $500,000 max credit for facilities that employers provide for childcare. So that's a benefit that's available. So the new new threshold for reporting 1099 miscellaneous or 1099, that should be NEC. That was another typo I did that I didn't fix. So the 1099 NEC, the non-employee compensation, the threshold is now $2,000. We've been stuck with a $600 threshold, I think, since the 1950s. We now have $2,000. I have a feeling, well, I'm pretty confident $2,000 in 2025 is a whole lot lower in nominal dollars than in real dollars, I should say, than $600 was in 1950, but that's the threshold there. There for 2025, we have a 1099K threshold. These are for credit card sale transactions of $20,000 or 200 transactions. So that's a lot of you have been receiving those for several years now. There are a lot of expiring energy incentive credits. So some of these are business, some of these are individual. If you're looking to, I mean, so this will affect the buying an electric vehicle. This will affect putting solar into your home. It'll affect a lot of different things. So those are on their way out under the current law right now. Now, will they come into play again in a different administration? Probably, chances are, but what'll happen later on, we'll find out there. So the residential clean energy credit expires after December 31 this year. The clean vehicle credit is September 30th. The previously owned clean vehicle credit also September 30th this year. There's an alt fuel refueling property credit, which is June 30th of next year. And then energy efficient commercial building deduction is terminated. This is like the builder's credit is terminated for property beginning construction after June 30, 2026. There are a lot of others there. That's not a comprehensive list.
Can I just add a little bit on
Sure. Yeah, please do.
on the energy efficient commercial building?
Yeah.
I know. Yeah.
Okay.
Essentially, this is just a timing planning. If you do have something coming up that you want to take advantage of either the 45L or the 179D, 45L, they follow the same dates. So 45L will expire at 6/30/26. but we have to do all of our inspection and pre-workup for those buildings before they begin construction. So if you're trying to take advantage, if you're trying to take advantage of that, you want to get on a phone call with us to talk about the inspection necessities prior to the build. And we want to talk about making sure that we've started, we've broken ground before this cutoff date. 179D is similar, but it's post-construction, so we want to make sure that we do the analysis and determine the deduction capacity prior to 6/30/26 for completed projects. So there's just some timing constraints there. And really what it is I bring this up to say, hey, if you've got buildings on the horizon, either that are going to begin construction, let's have a conversation. And if you've recently completed, let's either have a conversation about 179D or cost segregation as soon as possible.
Chelsea, while you're standing up there, one question that came in online, the bonus depreciation, does that also apply to 39 years or just to
It-
5, 7, 15 years?
It does not. So the technical line on that is for tangible property with useful lives under 20 years. So
The one potential exception is the qualified production
Correct.
property, which is in place temporarily now.
Yep.
Through like
28.
28 or 29, yeah. So if it's manufacturing space or production space, that's a maybe. For other types, no. The last thing on this page here is partnership disguise sale rules. So these were rules that put into place. So partnerships or LLCs can have tax-free property contributions and tax-free property distributions. So these have been in place for many years, where sometimes partners would say, well, I will contribute this building, you contribute the cash, and then we'll dissolve the partnership and you take the building and I'll take the cash and we're both tax-free. It doesn't really work that way. There's a lot of reasons why that wouldn't work, but there were changes made in the law to some of the regulations that had been put forward, but they did confirm in the law that the basic disguised sale rule still applies. And that can be a complex thing, but if it comes into place, then you do some tax planning for that. Let's talk about corporate charitable contributions. You've probably heard about the changes on individual charitable contributions, and we'll talk about those next week. But the corporate, this would be C corporation. Anything in a partnership or an LLC is going to pass through on a K1 as a contribution. The limits are going to apply at the individual level. But in a C corporation, the charitable contributions are limited to amounts above 1% of taxable income. So that first 1% of taxable income, you get no deduction. That charitable contribution becomes non-deductible. Say there's $100,000 of taxable income in the C Corp, $1,000 of charitable contributions is now a non-deductible expense. And then anything over 10% is limited in the certain year, but it can be carried forward for up to 5 years. And that's the same as the old rule there. So the new change here is that 1% floor on charitable contribution deductions. Some of your charitable contributions will be non-deductible. So really, maybe reconsider whether you want to. That'll probably make charitable contributions a less viable or less preferred option for that. So anyway, but also keep in mind, you can marketing expenses, sales expenses are still allowable. So see where things go into play there. There's also an employer tip credit that has always been around for restaurant workers, where if employees are paid by tips, the employer can take a credit for the FICA that is paid on those. That it's expanded from just being restaurants only now to salons, or it's not every tipping industry. There's exceptions, but basically they're saying salons can be treated as restaurants on that. And that's all I had on those. Joe, Rick? Now the fun stuff.
Yeah, Chelsea was mentioning that bonus depreciation and expensing of R&D costs was the most interesting, but she's wrong. It's the international and the cross-border. I know that's why everybody is here for these, so we saved the best for last, so. Well, so hey, let's talk about what was actually not included. You may have heard about this. Did anybody hear about the revenge tax, the retaliatory tax? Well, oh, yeah, only Kevin's the only one that's heard about this. So this was all the buzz in the international tax world. there was this provision that was in the House bill and initially in the Senate bill that was called the revenge tax. It was essentially the US increased its withholding taxes on payments made to foreign persons, like dividends, interest, rents, royalties. And it was intended to be really a stick to get other countries to get rid of what the US considered unfair taxes that were imposed on US multinationals. Those unfair taxes were imposed under this global OECD Pillar 2 regime that had this under-taxed profits rule and digital services taxes. Basically, these taxes that would impact US multinationals. So Congress put this code section 899 in this version of the bill. And I was getting phone calls from UK folks and people in Germany saying, hey, Joe, tell me about section 899. It's the first time anybody, from the UK has used Internal Revenue Code sections in a sentence before. What happened was Scott Bessent, Treasury Secretary Scott Bessent, tweeted out on July 1st, right as the Senate was about to pass this bill, that there was an agreement with the G7. G7 is Canada, UK, Germany, Italy, I think is in the G7. But they came to this agreement that US multinationals would not be subject to these unfair, what the US considered unfair taxes, these undertaxed profits and digital services taxes. So we come to find out that section 899 was pulled out of the bill, and it actually did what Congress intended it to do. They wanted foreign countries to move on these unfair taxes, and they did. So interesting maneuver. So you can bring that up at parties. Okay. In international provisions, you may recall the Tax Cuts and Jobs Act introduces 3 acronyms that you could also bring up at parties, right? One is called Global Intangible Low Taxed Income, commonly called GILTI. The other one is Foreign Derived Intangible Income Deduction, which we commonly call FDII, as in 50 cent. And then lastly is BEAT, Base Erosion Anti-Abuse Tax, right? These top 2 was a carrot and stick in the international space. GILTI is a deemed dividend inclusion that happens from your foreign subsidiaries, even though they don't pay an actual dividend. And this FDII is the carrot that provides US corporations with a favorable deduction when they export goods or they export services to foreign countries. So good guy for FDII, bad guy for GILTI, right? The term GILTI, is obviously a bad term, but it's said, hey, if you're a foreign subsidiary, if you're a US multinational, a US parent that has a foreign subsidiary, and your foreign subsidiary earns a return profit in excess of 10% of its tangible property, its property, plant, and equipment, there's this fictitious dividend that needs to be taxed in the United States. And so now the new provision, Congress tinkered with it. It's now instead of GILTI, it's now NECTI, which is net CFC tested income, which is essentially they said, we're going to get rid of that 10% deemed return on your tangible assets and say that every dollar that your foreign subsidiary earns is now potentially subject to this deemed GILTI inclusion. So we go from GILTI to NECTI, and on the FDII, we go from FDII to FDEI, which just means foreign derived deductible eligible income. Did I say that right? Foreign derived deduction eligible income, now FDEI, and then we kept BEAT. So the summary for all of you is that Congress just tinkered with these calculations and they gave them a new name. Okay, so the good guys on NECTI, right? So old, GILTI, new NECTI. They gave us some additional provisions that made the foreign tax credit better for us. That's a good guy with some expense allocation R&D and interest expense could be allocated to US source income. That makes our foreign tax credit limitation less bad, more good. A bad guy, the rate on GILTI through its mechanics, the tax rate goes from 10.5% to 12.6%. Another good guy, there's a limitation on the foreign tax credit. It was 80%, it goes to 90%. And then another bad guy is that they pulled out that qualified business asset investment piece, which just basically says every dollar of income or profit your foreign CFC generates is potentially eligible for this GILTI inclusion, this deemed dividend up at your US parent. So the overall summary, the jury's out. We've got a bunch of good guys, we got a bunch of bad guys. It depends on your facts and circumstances. I'll give you an example. Here's the TCJA version of the calculation. Here's OB3's version of the calculation. So the example is we've got a Canadian subsidiary that's owned by a US parent. It generates a profit of $2 million. It's got tangible assets of $10 million of property, plant, and equipment, etc. And it pays $200,000 of Canadian tax. You can see, and I won't bore you with the details, but in this scenario, we pay $35,000 of extra federal corporate income tax under the old rules. Under the new rules, we're going to pay higher amount, $97,000 with as a result of multiple mechanics change to this GILTI. So it's necktie now. Necktie there. Any questions on necktie, Kevin?
I suppose I just have a question overall. Are these changes, does it seem like they're trying to de-incentivize international businesses? Because it seems like there's already some policy changes with tariffs where they're trying to encourage us bringing, using more US businesses, more US manufacturing. Are these changes intend to penalize those that keep money abroad or what's the general idea behind it?
Yeah, well, Kevin, these provisions were intended to be revenue neutral, right? GILTI or necktie had some good guys and bad guys. I think the general feeling of the international tax community is really facts and circumstances specific. I mean, GILTI or necktie now is essentially a minimum tax that is required on your foreign earnings of your foreign subsidiary. That's really what GILTI is. And so, some thinks that the foreign tax credit limitation is going to be much juicier and better. So overall, US multinationals with foreign subsidiaries are going to be better off, despite the example that I just put on here. But that was just, this situation there. So jury's out, yet to be seen, intended to be net neutral.
So it's not necessarily a bad idea to look to get the international markets.
Yeah, exactly. I'd say right now it's still neutral. Good question. Great. I think in the interest of time, we're gonna skip that second example. All right, now we go back to FIDE. The summary for FIDE is we've got some good guys and bad guys. This is a favorable deduction that US corporations get when they export their sales. I'll allow you to just to look at the bullet points on this, but the summary is that the rate on the deduction goes down, but there's some good guys and bad guys. So again, supposed to be net neutral. The last good guy is it was temporary, it becomes a permanent deduction. This is to incentivize US businesses to export their product and services. Okay, this is the calculation. This is the old calculation here. This is the new calculation there. So we take our gross income minus 10% on your tangible assets, multiply that by a ratio of foreign revenue divided by total revenue, multiply that by 37.5. That's the old FDII deduction. Now the new one is we take gross income and we get rid of the 10% hurdle on intangible assets. That's good. Multiply it by the same ratio. Rates go slightly down. That's the new FIDE deduction. Okay. All right, last thing is on the BEAT. BEAT is, and I won't bore you with this example, but all you need to know is that the BEAT is also a minimum tax. It imposes now a 10.5% minimum tax, generally on inbound clients, foreign parent, U.S. subsidiary that is deducting royalties, interest, other things to its foreign parent. So all you need to know is that BEAT got slightly worse. And that's the summary of the international provisions. So, and I think the end of our presentation. So now we'll just open it up to questions. Any online, Brandon?
No further questions.
No further questions. Great. Okay. Yes.
Chelsea, on that, for participating for the R&D expenses being amortized, refiling for an S corp, what implications is it? Do all of the pass-through shareholders have to refile?
Yeah, so for small businesses, if you are choosing the amendment option,
Right.
so let's say, you know, you're, as a pass-through entity, you're amending 2022 in order to expense those items. Those would pass through to a K1. Subsequently, the shareholders, each of the shareholders would have an adjustment at the personal level, where they could amend their own returns and take advantage of the credit in the same tax year. So
If they didn't, say they're a very minor shareholder, if they chose not to because the refiling would cost more than the
then the
benefit
credit
of it,
availability.
would that make them subject to any additional scrutiny?
Not necessarily, because really the amendment would be coming to the IRS and potentially saying, hey, you owe me money, right? So, in that circumstance, of course, we want to take a look at what's happening at the individual level, if we're preparing the return or what kind of hurdle you have. But yeah, I mean, it essentially the IRS isn't going to say, hey, you forgot to file this, here's your extra.
We owe you money.
The challenge we just run into, so
You have.
we've got a lot of owners, right?
Yeah.
Got, like, on the one end, someone that owns 30% and someone that owns 0.5%.
Right.
And so just the benefit to this person might not even.
Yeah, and one of the things that we would potentially want to take a look at, I know specifically in your situation, is, you know, those majority shareholders. If it rises to the level that it's worth it for them, you know, do we want to go ahead and amend? And then just give the caveat to those lesser shareholders that,
Right.
hey, you're gonna get an amended K1. Talk to Squire and get some consultation on whether or
Right.
not it's worth it, or talk to your tax practitioner and see if you need to.
And that's kind of what we're doing. I just wanted to make sure that we're not gonna fall into some kind of trap by not refiling.
Well, and I think we're still waiting for guidance on what the amendment process is, because there are some partnerships, actually quite a lot of partnerships that have a very cumbersome amendment process.
So,
That in that case, maybe not amending this, but I mean, it obviously depends on the amounts involved
right.
and what will be involved in going through to claim those. So, and I think we're going to receive more guidance.
Yeah.
You mentioned the 3115. Is it going to be a simplified option, or what do we do on that?
Well, and another interesting thing to note, especially in an S corporation situation, is that if you choose to do the catch-up method, let's say, hey, we don't want our 22, 23, 24 shareholders to have to go and figure this out, whether or not they have to amend. If we choose the 25 option, the thing to remember is that people who may have participated in 22 and then say they sold their shares and got out, and now we have new members in 25, the catch-up method will affect shareholders of record at 25. So they could benefit from that catch-up, whereas the people who were there only benefited to the extent of the amortization in those years. So again, cash flow planning as well as just ownership planning. Who really wants to reap the benefit of the changes?
Thank you.
Great. Chelsea, another R&D question online for you. What risk is there to increasing R&D expenditures on the amended returns for 22 and 23 when compared to the original returns?
Yeah. I think that's a really great question. You know, obviously, when we go through and consider R&D expenses under section 174, if we're going through and we're amending and we're increasing those amounts,
We just need to have the justifiable reason to say why we've now considered them to be section 174 expenses. I think that, unfortunately, when we were put into this capitalization requirement, so, there was a consideration of how conservative can we be on the capitalization. It likely resulted in, for taxpayers who also pursued a section 41 credit, it probably resulted in a lower credit, right? So there's kind of a double-edged sword there, right? But I don't think the IRS is going to be coming down on these with a magnifying glass, just because you changed a certain level of 174. I think more increased scrutiny is whether or not you didn't claim R&D at all, right? You didn't capitalize, you didn't do anything as far as R&D is concerned. And then you're coming back and you're saying, oh, actually, we did. And I think that's the larger question. But again, we can answer that so long as we have a justifiable business purpose to say, hey, these are section 174.
So if you hadn't previously participated, you can still amend opt into it. You just might face some scrutiny or you might not.
I don't think as far as, obviously, we never know what the IRS is thinking as far as the audit regime, but it has always been in place that you can amend returns to claim R&D expenses and credit, right? So that hasn't changed. That is still the option and opportunity to taxpayers, is to go back and amend to claim R&D expenses and calculate a section 41 credit. So I don't think that there's any higher scrutiny or concern here. I just think we want to make sure that we go through and we calculate it appropriately.
Chelsea, do you maybe want to speak to just like, how would you document those expenses, the justification for that?
Yeah, definitely. I think, anytime we're looking at changing environments and maybe we just didn't know, right? So you have an environment of research and development, but you were not aware of the capitalization requirement in 22. That is a perfectly justifiable reason. Maybe you were implementing new means and methods, but didn't know that they arose to the R&D section 174 language. So it's all just, again, documentation, emails, correspondence, project lists, things like that are all questions that we're going to ask along the way to determine your R&D spend. So every business is so different in those environments that it's just a matter of saying, hey, let's talk about what your environment is and whether or not it was an R&D expense. Is that?
Any other questions? Okay, I think we'll end. Special thanks to everybody that came in person and online. Stay tuned, or please come back next Tuesday, 10 o'clock, to go over the individual provisions. It's going to be a lot more fun.